Welcome back to Echo Trade. Jeff Roth here. Today we have Ryan Redfern from Shadowridge Asset Management. Ryan, appreciate you being here. How's it going?
Great. Thanks to be here. Good. Thanks for being
So,
here.
yeah.
Good to be here. Thanks for having me.
Yeah, for sure. So Ryan's a new partner on the platform. And today we're talking about they're putting up the Shadowridge Alt B strategy. It's a pure bond portfolio. I think it's the first pure bond portfolio on the platform. So we're excited to have it kind of balance out some all equity portfolios. So Ryan, why don't you kind of just give us the outlook on the portfolio, kind of again, being an all bond portfolio, the makeup of the strategy and kind of the thought process behind offering that on Echo Trade.
Sure. Yeah, it's certainly something that you don't normally have, and you don't on Echo Trader have it. So I think it's an interesting mix. I'm generally a believer that having a diversified things help smooth performance of a portfolio when you mix multiple strategies. But if you own the aggregate bond index, that for the last 3 years has lost you money and has not added any benefit to what you do. And we've been doing this for years, in this looking for bond sectors or segments that are consistent and steady with lower volatility and actually do quite a bit better than the ag as the index. So that's our goal, is to own five. It's a very simple, equal weighted five ETF portfolio of different risk levels. A couple that are like just above bill or T-bills, and then we kind of go moderate. And then we have one or two that are aggressive, kind of depending on the environment. I think we do actually own like midterm bonds right now, where we haven't in quite some time.
Gotcha. Yeah. So, I mean, again, with like the idea of very, very high level, to have a bond portfolio to balance out just an all equity portfolio and kind of minimize those kind of, kind of swings, I guess. Right.
For sure.
Yeah. And then, but also, like, to your point, if you're just kind of being passive with hey, here, throw it in some bonds with the index, then you're not even underperforming. You're losing money the last couple of years. It's been a very strange kind of bond market the last few years. So, but for you guys being actively kind of searching for, outperformance, you guys have done pretty fantastic, in relative to that market. So to be able to kind of have something to balance that out, but still be able to kind of search for that actively managed outperformance within that benchmark.
Right. And there are sectors of the bond market. I mean, it's a very big market. People forget bond is not just like the aggregate or treasuries or something. I mean, floating rates have been fantastic, where you can make 8-9% on these things with like zero drawdowns. It's been fantastic, with the exception of April this year. It got a little choppy, but for the most part, there are spaces that you can be in or rotate into that are getting like equity-like returns, but with like fractional risk. So that's what we're shooting for with this strategy.
Yeah. And that's a really good point to make, because again, you kind of look at it as this is going to be something, in addition to my equity portfolio, but with what you guys are going about it, and with the areas of the bond market that you can have equity-like returns, but with that almost no drawdown in some cases, like you said. So that's really attractive. And, so maybe this is something that's for the more conservative investor. Like maybe this is like the entirety of their portfolio until they get to where they can kind of start adding some more risk with some other kind of equity-based portfolios. That's an interesting kind of outlook on that, definitely.
Absolutely. And we're thinking absolute return. So we're wanting consistent, steady, the most flat equity curve I can possibly create. So that lends itself well to higher volatility models that you may pair it with, or maybe do a fractional, pairing. But, it really smooths your equity curve and keeps it going, lower left to upper right in a more steady way.
Which is attractive for pretty much everybody. So
exactly.
So talk about kind of the process then. Like, how are you guys going about? Like you said, you kind of have if I heard you right, 5 ETFs equally weighted. How are you guys going about kind of identifying where those ETFs come from? Like different sectors of the bond market. What are you searching for? How do you kind of widen or narrow out that universe of options?
We continually screen. I always look at the max drawdown. That's a big factor for us. Look at the last 3 years. Typically, what's the worst case scenario of this fund, and then what's happened. Do we want to know, was there something in the bond market that was like, okay, that's why we had this crazy experience, and then the fund we picked, hopefully it does better than the others in that case. That's usually how it works out. And then just keep paring down. We really like the Ulster Performance Index. That's kind of like the finishing metric that we'll use, and then we'll run through chart. I'm very chart oriented. I'm a CMT, so I can't not be chart oriented and go like, do I like this chart at the end of the day? That's really what it comes to. So all the process coming down to that gets me to a list of maybe 10, 20 charts, and I'm like, what chart do I like the best? Which one is the smoothest, the most boring, but the best return we can possibly get for the least amount of risk?
Gotcha. So you're really looking at this, like you said, you're checking the charts. You're looking at it from a purely technical level, or are you guys
Yes.
getting in the purely technical levels?
Oh
Yeah.
yeah, yeah. I'm not. I kind of gave up on fundamentals back in 2008, so that's just.
I got you. Yeah. No, and it's great. I mean, I mean, for me, it kind of able to visualize everything, right, and be able to kind of see, it's more quantifiable, at least in kind of my opinion. So it's definitely interesting kind of way to go about that. And for the last handful of years, you've been doing this and this specific strategy for clients, correct?
This strategy, I believe, we're about 3 years on this one specifically. We've been running variations of it for probably a decade at this point.
Yeah. Gotcha.
We've been
Gotcha.
honing it for, and tweaking it and going, oh, what's the best metric, and then revisiting it, making sure it's working. And
Yeah. And so how are you kind of with your existing clients, with your kind of high net worth and other clients that you guys are working with at Shadowridge? How are you guys implementing this for their portfolios? And again, not advice for individuals within Echo Trade, because that's more of a personal consultation, but and just out of curiosity, how are you implementing this for clients?
no, this as I said before, it's an equity, it's a equity curve smoother. You can
Yeah.
have somebody have a lot of high risk stuff, and what's great is you can have a portfolio that's maybe 40% high risk S&P leverage, crazy stuff, and do 60% what we're doing, and you get a beautiful equity curve with
Yeah.
really low drawdowns, and that's what people want. The reality is people want the biggest returns, but it's the bad markets that really test how willing they are to stick with their strategy. And what we do
Mhm.
as a complement really helps them stick to those strategies. You can let the crazy aggressive side be crazy, and this will help you,
Yeah.
weather it and stick to it, because you need to stick with strategies. If you believe in something long term, you've got to stick with that strategy and not be like, oh, it had a bad month, we're done. Like, that makes no sense, because it's going to come right back at some point.
Yeah, no, and that's actually what I love about Echo Trade, because some people, hey, you can just put your money in the SPY, maybe the Qs, and then just sit on it forever and forget about it. But the reality is most people don't do that. They don't have the emotional kind of fortitude to do that, right? They're gonna see April of this year and freak out. I don't know what's gonna happen with tariffs. I'm pulling all my money out. Then the market just kicks up from there. Or 2020. I'm scared. 2000. All the different examples. So, but with this, you're at least able to kind of lean on the expertise of somebody like yourself, that hey, I got a guy that's looking at this every single day. This is what you do for a living. I can at least kind of have more confidence in the strategy that I've chosen within Echo Trade. And then again, you add on to that with the alt B strategy that you guys are providing, to be able to hopefully, like you said, smooth out that equity curve and kind of minimize those drawdowns when the equity markets go a little bit crazier. So any final thoughts, Ryan?
No, to go back to that, I feel like we're beating this drum, but it's really it's the things are picked in a way that really are very low stress. So, I'm not stressing it. I'm not turning over the portfolio a lot unless I have to. We may go months without doing something. April this year was definitely an exception, where markets got a little crazy because of the tariff tantrum. But it's an equity smoother. It helps you get where you want to be, in a very low stress kind of way.
Yeah. No,
That's my goal.
again, I like it again, because I think a lot of people within Echo Trade kind of are probably a little bit more aggressive than kind of your average, high net worth client. But everybody wants to kind of, have low stress with the upside. So I
Right.
think it's an awesome addition to the platform. I'm excited to have you guys on, and appreciate your time. Thanks, Ryan.
Thanks for having me.